When it comes to buying a home, your credit can affect much more than whether you qualify for a mortgage. It can influence your loan options, your interest rate, and ultimately how much your financing may cost. But understanding credit doesn't have to be complicated. In this video, I'll break down what you need to know about credit, how lenders look at it, and some of the steps you can take before, during, or even after the mortgage process. Let's get started. Let's first start off with why credit matters to lenders. When you apply for a mortgage, the lender wants to understand how reliably you have managed borrowing money in the past. How you performed on your auto loan and your credit cards show how reliable you are. And your credit history helps the lender evaluate the likelihood that you'll make the mortgage payment on time. But credit is only one part of the decision. Lenders also review your income, employment, assets, debts, down payment, and the property you're purchasing. And the goal is to understand your complete financial picture, not just simply your credit score. And credit can also impact your loan options. Your credit can influence which mortgage programs may be available to you. And some programs have different credit requirements. And your profile may affect your down payment, your mortgage insurance, the interest rate, or even other loan terms. Now, that does not mean you need to have perfect credit to buy a home. It just means that we need to understand where your credit stands today so we can identify the options that fit your complete financial situation. Now let's talk about credit risk and interest rates, because your credit profile can affect the interest rate and pricing available on the mortgage. Now, generally, a strong credit profile may provide access to more favorable loan terms, but your credit score is not the only factor that determines your rate. The loan program, the down payment, the property type, occupancy, loan amount, and current market conditions may also affect pricing. Now, this is why two borrowers purchasing similarly priced homes may receive different loan options. Score ranges and what they mean. So, credit scores are commonly grouped into ranges, but lenders do not all use those ranges in exactly the same way. A higher credit score can generally suggest a lower level of credit risk, while a lower credit score may indicate recent challenges, limited history, or higher debt usage. And there's no single score that guarantees approval or automatically disqualifies every borrower. The meaning of your score depends on the mortgage program and your complete financial profile. Credit scores are commonly grouped into ranges, but lenders do not all use those ranges in exactly the same way. A higher credit score generally suggests a lower level of credit risk, while a lower score may indicate recent challenges, limited history, or higher debt usage. And there's no single score that guarantees approval or automatically disqualifies every borrower. The meaning of your score depends on the mortgage program and your complete financial profile. Mortgage lenders use credit scores to help evaluate the risk associated with a loan. And depending on the transaction, lenders may review scores from all three major credit bureaus and apply the scoring rules required for that loan. Your score may affect eligibility, pricing, mortgage insurance, or required documentation. But lenders also evaluate your income, assets, debt, employment, property, and payment history before making a final decision. Your credit report contains information reported by lenders and other data providers. It may include credit cards, auto loans, student loans, mortgages, account balances, payment history, credit limits, collections, and recent inquiries. It can also contain identifying information such as your name and previous addresses. Your credit report and credit score are related, but they are not the same thing. The report contains the underlying information used to calculate the score. When reviewing your credit report, begin by confirming that your personal information is accurate. The next, review every account. Check the creditor's name, the status, the balance, the limit, the payment history, and any reported late payments. Then review collections, public records, and credit inquiries. Do not focus only on the score. The details in the report help explain what may be influencing that score and whether anything needs your attention. Credit reports can contain inaccurate information, such as an account you don't recognize, an incorrect balance, or a payment reported late that you believe was paid on time. And if you find any errors, gather documents that support your position and submit a dispute to the credit bureau reporting the information. You may also contact the company that provided it. Be specific, keep copies of everything, and allow the dispute process to be completed before assuming the report will change. Payment history is generally the largest category used to calculate a FICO score. Late payments may affect your credit differently depending on how late they were, how recently they occurred, and whether the issue happened more than once. Now, the best habit is also the simplest. Make at least the required payment by its due date every month. In automatic payments, account alerts can help prevent an accidental missed payment. Credit utilization compares your credit balances with your available credit limits. For example, if a card has a $5,000 limit and $2,500 reported balance, its utilization is 50%. Higher utilization may indicate that you are relying heavily on credit debt. Credit score models consider how long your accounts have been open, including the age of your oldest account and the average age of your accounts. Opening several new accounts can reduce that average and add new credit inquiries. Closing an older account may also change your overall profile. This does not mean you should never open or close an account. It means you should avoid unnecessary changes when preparing for a mortgage. The most important long-term credit habit is paying every bill on time. Set reminders or automatic payments for at least the minimum amount due. Then confirm that payments clear successfully. If you're struggling with the payment, contact the creditor before the account becomes late and ask what options may be available. There is rarely an instant credit solution, but a consistent record of on-time payments can help build a stronger credit profile over time. Reducing revolving balances may improve your credit utilization and lower your monthly obligations. Both can be helpful when preparing for a mortgage. At the same time, avoid taking on unnecessary new debt. A new car payment, personal loan, or finance purchase can change your debt-to-income ratio and potentially affect your approval. Before moving money or paying off an account, speak with your loan officer so the funds are used strategically. Review your credit early, ideally before you're ready to make an offer on a home. Starting early gives you time to identify errors, understand your balances, and address issues without rushing. Your plan should be based on the information actually appearing in your mortgage credit report, not general advice from social media. Sometimes the best strategy is to pay down an account. Other times, preserving cash or leaving an account unchanged may be more important. A lender normally reviews your credit when you apply or seek mortgage pre-approval. Credit may also be reviewed again before closing to identify new accounts, inquiries, balances, or monthly obligations. The lender may monitor other parts of your financial profile as well, including employment and available funds. Pre-approval is an important milestone, but is not a permission to make major financial changes. Your final approval depends on the information remaining acceptable throughout closing. While your mortgage is in process, avoid applying for credit cards, financing furniture, buying or leasing vehicles, taking out personal loans, or co-signing for someone else. You should also avoid substantial increasing credit card balances or closing established accounts without guidance. Even if a salesperson says a purchase will not affect your mortgage, speak with your loan officer first. A new inquiry, balance, or payment could change your approval or the amount you qualify to borrow. From pre-approval through closing, consistency is your friend. Continue making every payment on time, keep balances under control, and avoid moving large amounts of money without documenting the source. Do not change jobs, open or close accounts, or take on any new debt without first discussing it with your loan officer. If something unexpected happens, communicate immediately. It's much easier to evaluate an issue early than discover it shortly before closing. Some borrowers have limited credit history because they're young, recently established in the United States, or have simply avoided using credit. A limited history does not automatically mean home ownership is impossible. Depending on the loan program, other documented payment histories may sometimes help demonstrate financial responsibility. The important thing is to not open several accounts just to create activity. Let us first review what is available and determine the appropriate path. Now, late payments, collections, charge-offs, or other past challenges do not necessarily mean you can never qualify for a mortgage. The timing, severity, cause, and current status of the issue all matter. And lenders may also consider whether the problem was isolated and whether you reestablished a pattern of responsible payments. Just be open about what happened. For the lender, understanding the full story allows us to evaluate available programs and build a realistic plan. It may be possible to qualify for a mortgage after a bankruptcy, foreclosure, short sale, or similar event. Different loan programs have different waiting periods, and documentation requirements and the dates used to calculate those periods can be very specific. Circumstances and reestablished credit may also matter. So do not assume you are automatically disqualified or automatically eligible. We need to review the event, relevant dates, and current profile before determining your options. After closing, your mortgage becomes an important part of your ongoing financial life. Make every payment by the due date. Monitor your statements and contact the loan servicer immediately if you believe there's an error or anticipate difficulty making the payment. Do not ignore notices from the servicer. Consistently managing the mortgage can contribute to a stronger payment history while also protecting your home and long-term financial stability. Strong credit is generally built through consistent habits rather than quick fixes. Pay bills on time, keep revolving balances manageable, review your credit reports, and apply for new credit only when it supports a genuine need. Avoid making decisions based solely on short-term score change. The goal is to not chase a perfect number. The goal is to maintain a stable credit profile that supports your financial plans over time. Credit can be a useful financial tool when it's used intentionally. Your future goals may include refinancing, purchasing another property, investing, starting a business, or accessing home equity. Each new obligation can affect your monthly budget and borrowing capacity. Before taking on major debt, consider both the immediate payment and the effect on your long-term plans. The best use of credit is one that supports your goals without placing unnecessary pressure on your finances. A soft credit check may be used for an initial review, account monitoring, or certain pre-qualification processes. It does not affect your credit score. A hard credit check is generally used when you formally apply for credit or when a lender needs a qualifying mortgage credit report. Hard inquiries become part of your credit history and may have a small temporary effect on your credit score. Always confirm which type you are authorizing before submitting a credit request. A soft inquiry does not affect your credit score and is generally visible only on the consumer-facing version of the report. A hard inquiry may affect your score because it indicates that you are seeking new credit. The effect is usually small and depends on your complete profile. Credit scoring models also provide special treatment for mortgage rate shopping when qualifying inquiries occur within the applicable shopping window. If you're beginning the conversation and want an initial review, a soft credit check may be the appropriate starting point. If you're moving forward with a formal mortgage application or have been instructed to complete a qualifying credit report, a hard credit check may be required. Do not guess. If you're uncertain, contact me before authorizing either option. I will help you choose the credit review that fits your stage of the mortgage process.